Hey everyone, happy Thursday, July 17th. It's about 10:30 in the morning on the West Coast, and it's time for another market update. 2 weeks ago was very data heavy. Last week was very narrative heavy. This week was a little bit of both. But really, the main couple subjects that kind of dominate the markets once again was on the narrative side. Tariffs over last weekend, there was new tariffs announced against the European Union and Mexico, which again, markets don't really like the tariffs, like we talked about before, but time will tell what happens there. But that was one piece of news on the tariff side. And then the other thing that's come on, especially yesterday, President Trump and Fed Chair Powell are once again at odds. Yesterday, news broke that President Trump had told some lawmakers the night before that he was going to fire Fed Chair Powell. The markets that when that news broke, the markets reacted negatively across the board. And it's interesting because most people would assume that hey, if Fed Chair Powell gets fired because he's not cutting rates, then the new guy, whoever or gal that ever gets put in place, would then cut rates. And isn't that good? Isn't that good for mortgage rates? This goes back to what we've talked about before. The Fed rate is not directly linked to mortgage rates. Basically the way the markets reacted yesterday was, short-term stuff like two-year yields, those reacted positively, but the more the long-term stuff, which mortgage rates go off of, like the 10-year treasury yield, that went up, that reacted negatively. So basically short term, a little, maybe some positive, but long term, the market's viewed as a bad thing. The markets want a free market. They don't want the president in control of the market, which would be one of the takes if he did make the decision to fire Powell. A little bit later in the day, President Trump came out on True Social and said that he will not be firing Powell. So that is where we're at there. The markets rebounded after that, although the stock market rebounded faster than the stuff that controls, the longer term stuff, the stuff that controls mortgage rates. So today, not too much volatility there. We haven't heard any more news about that. But that was a big deal because, like I said, the markets want to be free, and it would be unsettling for the long-term debt stuff, and that's the stuff that has the biggest effect on mortgage rates. So, although the new person might cut rates, it might actually be bad, and the markets kind of gave us a preview of what that would happen if he did fire him, how everything would react. So that was important yesterday. Hopefully, that doesn't happen. Next thing, earlier this week we got June CPI. So PCE is the Fed's favorite form of inflation, but CPI is another important one to take a look at. It's the first look we get at June, and like I said here, it's bad on the surface, but when we take a closer look, it really wasn't that bad because it was expected to go up. Last, as these month to month, headline went up 0.3, compared to last month. But and then year over year it went up to 2.9. However, it was replacing really low numbers from last year. I think it was flat or even negative last year. So this was expected. It actually went up slightly less than was feared. So that's a good sign. So even though the headlines were inflation went up, we all knew it was going to go up, the people paying attention, and it didn't go up as much as we were scared it was going to. The other part is that when we took a look at these numbers a little bit deeper, was that tariffs didn't seem to have much of effect yet. So they were kind of expecting, hey, okay, June is when we're going to start seeing these tariffs hit the product and hit consumer inflation, but we really didn't see a lot of jump there. It was mainly energy costs that made the headline go up. So again, bad on the surface, but once the markets digested it, wasn't that bad. The next one we got the day after yesterday was the June PPI. So this is producer inflation, and this was the opposite. This was good on the surface, but dot dot dot. What happened was it came out, headline was zero, so no movement at all. Great. It was supposed to go up 0.2. Core, same thing, was supposed to go up 0.2. Nothing. Didn't go up at all month over month. However, they revised the previous months up by zero point 0.2 on the headline and by 0.3 on the core. So on the headline, it basically came in as expected. It went up 0.2. It just, what they were comparing it to was less. Same thing with core. They revised that one up for the previous month. And so this was actually up slightly more than was expected once you account for that revision. Again, still pretty moderate numbers. Year over year, we are at 2.6, or I'm sorry, 2.7 for the headline and 3.2 for the core. But there is some talk that companies did buy product up front before the tariffs. Maybe there's going to be some more inflation later there. But like I said, it was one of those ones where you can't really judge it on the headline, just like the CPI, because once you dug in a little deeper, there was a reason why it came in flat. It was because last month they revised higher. And then today we got June retail sales. This is important. Fed's paying attention. Goes into our GDP. The stronger our economy is doing, the less likely it is that Fed will cut rates. This came in at plus 0.6 month over month. More than expected. However, again, they made some negative revisions the previous month, and last month was 0.9%. So in comparison, went up, but last month was really bad. So seems like a little bit of a slowdown, but it'll be, again, it's important because the more we're spending money, the stronger our economy is doing, and the stronger our economy is doing, the less likely is the Fed will cut rates, and we want the Fed to cut rates because we want mortgage rates to come down. Next thing, initial jobless claims. Again, important. Fed's paying attention to jobs because that affects our economy a lot. And it was supposed to be about 233,000 new job claims. Came in at 221. So this is dropping again down in the 220s. So a lower number. However, continuing claims is still higher. I think we're over about 1.96 million. So that's a really high number. So what it's looked like for a while in the labor market is companies are hesitant to lay people off. Once people do get laid off, it's harder and harder to find work, especially full-time work. A lot of people find part-time work, but they're not finding full-time hours anymore. Next thing, so where does that leave us? So last week we were about 6.79. Today, the average conventional for good borrowers, according to that lender survey, is at 6.82. So we've been in this 6.7 to 7 range for quite a while now. Waiting for something to break, waiting for jobs to, to get in a little trouble. So maybe the Fed makes their move, but really just kind of been, hanging out here in the 6.75 to 7 range. Important dates. So the Fed is meeting July 30th. That's the big next one. We're not going to get any. I think we get PC inflation the day after that. A couple days after that, we get new job reports. So that's the next big date. Right now, I think there's a 3% chance they cut rates at that meeting. So probably not going to happen unless something drastic happens in the world, or maybe something happens at that with Chair Powell and Trump and Fed, President Trump. But again, even if that happened, maybe if they cut rates, maybe we wouldn't get a positive bump in mortgage rates. So that will be important to keep an eye on. So right now, again, like what we need inflation down. We need jobs to weaken a little bit because we need the Fed to start cutting rates. And in September right now, they're showing that chance of being about a 55% chance they cut at that September meeting. So that's gone down a little bit, but that still seems to be our best chance the next time the Fed would cut their rate. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.